Hello and welcome to Let's Talk Business. I'm Priyanshi Sharma and let's start this segment with how the markets performed today. Well, Nifty and Sensex continued their upward momentum for the second day. Nifty surged over 100 points to close above 18,700 levels. Meanwhile, the Sensex settled above the 63,000 mark for the first time since December. My colleague Hiral Dadia joins us for more on this from the BQ Prime newsroom. And Hiral, take us through the highlights of the market action today.
Markets extend gains for a second consecutive session, and if you see Nifty, that's ended above the 18,700 mark. In fact, the Sensex has ended above the 63,000 levels for the first time since December, and all the sectors managed to end in the green, though you had the Bank Nifty, which underperformed the benchmark indices, though ended in the positive as well. In terms of mid-cap and small-cap index, we saw gains of almost around 0.8% to 1%, and it was RIL as well as ITC that led the gains in today's session. The market breadth has been pretty much skewed towards the bull, so that's a positive. So it's going to be an interesting month ahead. In terms of individual counters and sectors, real estate stocks advanced, and this was mainly because the residential prices have jumped as per a Knight Frank report. And if you see the Nifty Realty Index, that has gained 36% since March lows as compared to a 3.6% to the global gauges. FMCG companies were in focus as well in today's session. In fact, good moves coming in there as the government has imposed a stock limit on wheat for the first time in 15 years and the mandi prices of wheat have increased by 8%. In fact, the decision will actually hold the increase in terms of wheat prices. Dairy companies were also in focus as ICICI Direct Securities is expecting a correction in the milk procurement prices, which could lead to a margin expansion in FY24. Apart from that, few of the top gainers, as we already mentioned on Nifty, were from the FMCG pack that you can see on the screens and the consumption space. In terms of losers, you had a Kotak Mahindra Bank, Adani, HCL, as well as SBI in trade today. Very lastly, newsmakers. Zee Entertainment, one of the top ones in focus. In fact, the stock corrected quite a bit post the SEBI order. Inox Wind hit a record high in trade today as well. And you had MRF, that's actually become the first company to hit the 1 lakh mark. Other companies like Indigo, Signet and Devyani were also the newsmakers of the day. So overall, a lot of stock-specific action is what we've seen. Back to you.
Thanks, Hiral, very much for that. And more good news on our way. Auto sales continue to rise in the month of May and they saw a surge of 18% on a year-to-year basis. The data from SIAM shows that passenger cars, utility vehicles and vans made up the majority of the domestic market sales for the month end and sold over 2 lakh units. Meanwhile, two-wheeler sales, which include scooters, motorcycles and mopeds, they surged over 17% for the same period. And while we're talking about auto sales and we also spoke about markets, an important update from the markets today. For the first time in India, the share price of a company crossed the 1 lakh rupee mark today. And the share that we're talking about is MRF. MRF has become the first stock to cross the 1 lakh rupee mark per share after its share price jumped 1% in the early trade today. My colleague Alex Matthew joins us with the key milestones that the tyre company has witnessed till now.
MRF. It's known for centuries on the cricket pitch, from Sachin Tendulkar to Brian Lara and now more recently Virat Kohli. But today, India's oldest tyre company hit a 1,000th century on the stock market, hitting the 1 lakh mark and becoming the first Indian stock to reach that milestone. It was only a matter of time if you think about it, because that stock has grown by 25% per year since 1992 when it hit the 1,000 mark for the first time. The last leg of that run has been a sprint, with the stock growing as much as 45% in just the past year. Now, a lot of you will be familiar with the tyre business and also MRF's sponsorship of cricket as well as racing. But did you know that the company started off as a manufacturer of balloons in 1946? It's come a long way since that point. And part of the reason why it hit that 1 lakh mark is that the company has had a policy of not undertaking any stock splits or issuing any bonus shares. The consequence of that, of course, has been lower liquidity. But the long-term shareholders of the company are certainly not complaining.
And another share in focus today, that's Zee Entertainment. The shares of Zee Entertainment fell nearly 7% today after the Securities and Exchange Board of India, or SEBI, barred the promoters of Zee Entertainment from holding board positions. With market regulator barring Zee Group promoters Subhash Chandra and Puneet Goenka, the much-awaited Zee and Sony merger might hit a hurdle. Now, to understand the implications of the SEBI ban on this merger, BQ Prime's Payaswini Upadhyay spoke to corporate lawyer Murli Neelakantan. Listen in.
Time is going to be a big factor. Given the complexity of the proceedings now, it's stuck in 3 different places, and each of those gets unstuck and then goes through the appeal process again. So time is going to be a factor here. Now, if time is a factor, then it's up to Sony if they want to continue with this or not. And they will have a challenge because their shareholders are going to be asking their board what diligence they did. Did they know all of this? If they didn't know all of this, then now that they know it, do they still recommend that the merger continues? And with the changed knowledge of facts that we have, is it going to be a different scheme that they will approve rather than the scheme that is before the NCLT? So there's going to be a lot of pressure on the Sony board, and Sony shareholders should be really worried. They should understand that they may not have got the deal that they thought they were sold by the board and recommended to them. So I would think that there is going to be a lot of pressure there. And that would mean that as time passes, this gets muddier. There might be a little less interest from the Sony side of the deal to actually close this in the form that it is at the moment.
And moving on, banks' credit growth outpaced deposit growth and liquidity pressures in the financial year 2023. So here's ICRA's Karthik Srinivasan and Moody's Investors Services Anbarasu with their outlook on the credit growth in the current financial year as they spoke to BQ Prime's Jaspreet Kalra on the sidelines of the Moody ICRA India Credit Conference. Listen in.
Deposits have been underpacing credit growth by almost 500 basis points at this point. Is this an ongoing concern? What does it take for deposits to start outpacing credit growth? Karthik, you first.
Okay. When you look at deposit growth and credit growth in percentage terms, yes, you see a huge difference over there. Mm-hmm. On an incremental basis, if you see the absolute numbers, credit has outpaced the deposit growth in FY23. Absolute terms, not so much of a large margin as what one sees in percentages. We expect the trend to sort of continue into FY24 as well, whereas incremental credit growth should outshine the incremental deposit growth, but possibly with a much smaller margin.
Now, Alka, you look at the global picture here. What's your outlook on how this compares to the global scenario, and how can we bake in learnings from that?
Sure. So one thing, the weaknesses that came out from the US banking system was that the deposits was very concentrated with certain corporate depositors, and a concentrated deposit base book lends itself to risks.
Sure.
But when it comes to India or even broadly Southeast Asia, we see that the bank's deposit bases are very retail in nature. So to lead on to what Karthik was telling, maybe there's higher deposit competition, but that would mean that the banks will need to pay up a bit more.
Okay.
Their net interest margins would get perhaps come down a little bit. Our expectation is that the NIMs of Indian banks have peaked, or net interest margins have peaked. Deposit competition would mean they need to pay up more.
Sure.
Having said that, India is still a very much a deposit-led banking system. Mm-hmm. For public sector banks, deposit to loans ratios is around 75% or so.
Right.
So they do have headroom to grow, and private sector banks need to compete for deposits. But the US is a very specific situation with large concentrated depositor bases, which by itself lends to a number of weaknesses, which we don't see in this part of the world.
That's all we have for you in this segment of Let's Talk Business. Do tune in at 5:30 p.m. every weekday to catch the latest business news. Thanks very much for watching.